Just in, the Fed's reverse repo facility just plummeted to a jaw dropping $28 billion, dollars, the lowest level in 4 years. Why does this matter? It's a signal that the financial system's liquidity is drying up fast, and the ripple effects could be widespread and significant. In this video, we're breaking down 5 key points you need to know about what this means for markets, banks, and maybe even your wallet. So here's what's called the reverse repo facility. And what this is, the easiest way to think about this is excess cash that the Fed or the Treasury, there's excess dollars in the system, and we do not want them actually in the real economy. We want them kept secure. We want to sterilize them and lock them up so that they cannot go out into the economy chasing real goods and services and driving prices up via inflation. So as this balance is going up, that is dollars being removed from the system, excess dollars being removed from the system. And as it's being ran down, those are dollars that are coming back into the system. Hopefully that makes sense. Well, today, it just happened. The Fed reported that this reverse repo facility is down to just $28 billion, and that is the lowest level in 4 years. So, what is the reverse repurchase facility and why does it matter? So, the Fed determines the price of the dollar. If you were to ask most normal people, what is the value or the price of a dollar, they would probably think and tell you what they could purchase in terms of real goods and services. But there is actually technically a price of the dollar. And here we're looking at overnight dollar markets. In blue, we have the discount window rate. This is set by the Fed. In green, we have the IORB. This is the interest on reserve balances, also set by the Fed. In white, we have the federal funds rate. And in red, we have the reverse repo rate, also in red. So the way to think about this is overnight dollar, the price of an overnight dollar. These are interest rates over here on this scale, and we'll get to the purple in a second. But the key thing to remember here is that there is a free market for dollars. That is SOFR, or the Secured Overnight Funding Rate. This is basically on supply and demand. If the supply of dollars in the banking system, in the financial system, if the supply of dollars is too low relative to the demand, if demand for dollars is spiking and there are actually very little dollars in the system, you would expect a higher interest rate, right? If you're the only person with dollars on Wall Street and everyone is coming to you wanting your dollars on an overnight loan, via SOFR, well, you're going to demand a higher interest rate. So SOFR is more of a free market way of determining the supply and demand for these overnight dollar loans. So as dollars are becoming too scarce, you see SOFR start to spike. And what the purple line shows is the spread of SOFR, or the cost of a dollar on an overnight basis, relative to what the Fed wants it to be via the federal funds rate. And this normally happens during the end of quarter. We can see here October 2024, again in December 2024, again in June of 2024. So it always generally happens at year end, at quarter end, when there's a bunch of reporting requirements, window dressing, all that sort of stuff. At the end of the quarter, you normally see that. Well, the point here is the Fed is not really setting a price for the dollar like most people think. When they cut their interest rate or raise their interest rate, they are actually moving a range. That is how they actually get the Fed funds rate. And at the upper bound of the range, they have the discount window rate. And then at the lower end of the range, they have the reverse repo award rate. This is the range that they use to set the price of the dollar. So we can see the discount window rate is at 4.5, and the reverse repo, which we were just looking at here, that is at 4.25. So there's a bit of a spread there. That range is where the Fed wants SOFR to be in. Generally, hopefully close to the middle of the range, close to Fed funds. Now, the reason how they mechanically do this is the discount window rate is setting a ceiling, right? It is saying that no matter how scarce dollars get, like they did here in December 2024, SOFR is spiking. It spiked about 19 basis points over the federal funds rate. No matter how scarce dollars are getting, we, the Federal Reserve, will always come in and loan dollars out at 4.5%. But on the other hand, If dollars are too abundant, if there's way too many dollars, and therefore the price of each dollar is going to be lower, the interest rate of each dollar loan is going to be lower. If there's an overabundance of dollars, we, the Fed, will always come in and guarantee at least 4.25% in terms of interest for those dollars. And so the Fed generally, again, likes to keep the SOFR in this range between these two bounds. And we can see there are brief periods of time where SOFR breaks above or below. In the case of 2021, SOFR was breaking below the reverse repo rate. Well, that happens periodically, and it's generally a sign of the Fed losing control. And it's generally very short lived. If it's not short lived, things get very ugly very quickly. But as we can see with the SOFR Fed fund spread, you get a bunch of these very, very abrupt spikes when dollar liquidity is scarce. Dollars are scarce, but then it eventually comes right back down. And the same is true back if you go back to 2021, where dollars were overabundant. We printed so many dollars that the value of each dollar was below actually the reverse repo rate, but it generally self-corrects. So if you see SOFR spend a lot of time above the discount window rate or below the reverse repo rate, that is generally a sign the Fed is losing control. But again, the way to think about this overnight dollar market, the discount window rate is the Fed guaranteeing the ceiling for the price of the dollar. The price of the dollar, no matter what happens, we are willing to come in and loan you dollars at 4.5 and increase dollar liquidity, again, increasing the supply of dollars, therefore reducing the scarcity of dollars. And on the other hand, the red line, the reverse repo, is saying no matter what happens, if there's an overabundance of dollars, we, the Fed, will always buy, quote unquote, your dollars at 4.25. So you're setting a floor in the value of the dollar on an overnight basis. Hopefully that makes sense. So here's the Treasury General account. And again, this is the Fed's checking, excuse me, the government's checking account. You can think of it like the government's checking account that when they need to pay bills, this red line will come down. You can see the balance over here. We can see at the top here, hit a peak of about $1.8 trillion. Now, just like the reverse repo, where as the line is going up, dollars are being removed from the system. Very, very similar to that is the TGA, which again, as the red line is going up, what that means, those dollars, if you go from say 364 billion all the way up to 1.8 trillion, they have just removed about over $1 trillion from the real economy. So as the red line is going up, dollar liquidity is getting worse because those dollars are being sucked out of the system. Very similar to with the reverse repo when this is going up. They are both draws for liquidity. Now the opposite is true. If, for example, here Treasury takes the TGA from 1.7 trillion all the way down to about 114 billion. What that means is the Treasury just spent all those dollars into the economy, into the system. So what that means is the supply of dollars or the abundance of dollars was improving or increasing. And then in white, we have kind of net liquidity. This is a way of measuring net liquidity conditions. You take the central bank balance sheet, the Fed balance sheet, and you subtract out the reverse repo, which again, as this is going up, dollars are being sucked out of the system, and you subtract the Treasury General account, the TGA, here in red, because again, same principle. If the TGA is going up, dollars are being removed from the system. Now, one thing to point out here is that generally, as the TGA is being rebuilt, that is positive for the DXY dollar index. We can see that every time the TGA has been rebuilt back up, we see a pop or strengthening of the dollar. And the opposite is also true. When the TGA is being ran down and dollars are basically being injected into the system, dollar abundance, right? Dollar supply is increasing. Well, you see a weakening of the dollar, just like we saw here at the end of 2023 when Janet Yellen ran the TGA down. Well, what we know, why we're talking about the TGA, is we know the Treasury has said we need to rebuild the TGA. It is only at 464 billion. We spent it down by the way, the dollar weakened as they spent it down. We spent it down because we had the debt ceiling and we couldn't issue new debt. So we had to come up with the money to pay our bills. So we spent down the TGA. The problem is we don't have enough money in there to make us comfortable for the next, year of expenses, right? So very similar to a person, they want to make sure they have enough dollars in the TGA checking account. So what they're going to be doing, they announced this last month, is they're going to rebuild the TGA and build this back up. Well, the problem is they want to rebuild it back to $850 billion, which is about right here. It's kind of the upper bound of this range that the TGA had been in. So they want to take it back to 850 billion. Well, the problem is we're only at 460 billion. So that's about $400 billion that is about to get sucked out of the system. Negative supply shock or negative liquidity shock because dollars, 450 billion of them, are being removed from the system and just put in an account. Very similar to the reverse repo. These are dollars that were removed from the financial system, removed from the economy, and just stuck in an account, not really doing anything. And so they are both, as the lines are going up on the reverse repo, as the balance is going up on the reverse repo and the TGA, those are both negative shocks for the dollar. And the opposite is true. As the TGA or the reverse repo is being spent down, dollars are entering new dollars, new dollar supply, new liquidity is entering the economy, entering the financial system. So again, the TGA is not perfectly correlated to the dollar. We'll see another interesting correlation in a second. This is just one of many influences. But here we have bank reserves. So if we know that the Treasury is trying to rebuild about $400 billion into the TGA, we know the reverse repo or sterilized excess dollars, we know that this is only at 28 billion. So it can't really, they're not going to be able to rebuild the TGA from just the reverse repo because it only has $28 billion in it. So it has to come from somewhere. That 400 so billion dollars needs to come from somewhere. Where is it coming from? It's going to come from bank reserves. So remember, the monetary base, this is narrow money, the narrow money definition, monetary base M0 is comprised of two things: bank reserves and currency, physical currency. This is kind of what I call official money, official kind of government money. And that's the monetary base. It's comprised of only two things: currency and bank reserves. Well, bank reserves are basically fancy dollars that the Fed creates and the banks hold in an account at the Fed. So bank reserves are increased during quantitative easing. And we can see that all the way through 2014. Bank reserves were rising and the Fed was printing dollars out of thin air, by the way. They were using those dollars to purchase treasury bonds and mortgage-backed securities, but the bank reserves were coming from nowhere. They were just being printed out of thin air. Well, what that means, of course, is that new dollars are entering the system. Well, the opposite is also true. Dollars or bank reserves can contract. Dollars can be destroyed. And the way that that happens is during quantitative tightening, just as we saw here during the last Trump administration when the Fed was engaged in quantitative tightening, which is the exact opposite of QE. So here was the major QE we saw during 2020. Huge increase in bank reserves, huge amount of money printing. The amount of dollars entering the system bank reserves went from about 1.4 trillion all the way up to 4.2 trillion. So like $3 trillion of bank reserves were printed. Well, what happened to the dollar during this period of time? It weakened. Of course, this makes sense because dollar liquidity, the supply of dollars is increasing. If the demand stays constant, the price of each dollar as measured versus other fiat currencies, the price of that dollar, the value of that dollar will decline. And the opposite is also true. When the Fed is engaged in quantitative tightening, they're basically destroying money or removing dollars from existence. And we can see here that that led to a strengthening in the DXY. As the Fed was engaged in quantitative tightening, we saw a strengthening of the dollar because the amount of dollars was being destroyed. It was being reduced. So therefore, the supply of dollars, it was getting more scarce. Therefore, the value per dollar had to go up. So when you combine the two of them, when you look at the TGA being a negative, right, as it's being built up, that's a negative for liquidity, negative for supply, or positive for the dollar in terms of price. The same is true with bank reserves. If bank reserves are going to be drawn down, as we just established here during this period of time in 2022, it also happened here during the quantitative tightening of Trump's first administration. The price of the dollar did go up during that time period. Um, just as the TGA being rebuilt is a negative for dollar supply, negative for liquidity conditions. If the bank reserves are being drawn down, that's negative for liquidity, meaning the price of each dollar will go up. Well, we established that the Treasury is not going to be able to find those 400 billion from the reverse repo, right? All this excess cash, there's basically nothing there anymore. There's only 28 billion, so it has to come from the reserve balances here in white. Well, again, what normally happens when reserve balances are decreasing? When dollar supply is becoming more scarce, well, the price of the dollar generally rallies. So you have two conditions, both the TGA being rebuilt and the bank reserves being drawn down. These are both signs of negative liquidity conditions and a shock in terms of dollar supply. You would expect, given recent history that we're looking at right here and right here, you would expect the dollar to appreciate. When the Treasury announced that they were going to rebuild the TGA all the way up to 850 billion, I looked at the reverse repo, it had 30 billion in it. Go, okay, well, it's not coming from the reverse repo. There's basically nothing there anymore. It's got to come from bank reserves. Well, if that happens, that's a negative for dollar liquidity. The dollar is going to appreciate. And so I made a note of it about a month ago that the dollar would likely show some strength here due to the rebuild of the TGA. Because again, the way that the Treasury gets the dollars is they sell debt. So the Treasury Department is selling debt. They're getting dollars from the real economy, right? Dollars are being removed from the real economy, from the financial system, and going into this Treasury General account and then just kind of sitting there. So both the TGA rebuild and the fact that there's basically nothing in the reverse repo anymore, so it's got to come from bank reserves, both of those are positive for the dollar in terms of the DXY index, which is why we flagged it about a month ago when that news came out. Sure enough, we have seen a bit of dollar strength, but we expect it'll probably continue, or at least this is a positive, this is a tailwind for dollar strength. Here is a chart that I think is interesting. So here's the DXY divided by the S&P 500. Again, with the relative chart, if the numerator is increasing faster than the denominator, the white line will go up. Well, what we see is when the DXY, or the dollar index, appreciates faster than the S&P 500, it almost always corresponds with a pullback in the S&P 500 and a pullback in gold. And the green boxes kind of, I tried to highlight some periods of time where this DXY versus SPX popped and started to kind of move sharply higher. It could be a short-term thing, but generally speaking, even the short-term moves are met with a pullback in gold and a pullback in the S&P 500. So you can see those highlighted in green. The reason for this is that if the DXY is increasing faster than the S&P, what that means is the price of the dollar is going up very rapidly. Well, why would that happen? It generally happens in negative liquidity conditions when there's a shock, a liquidity shock to the system. And so that generally is met with weakness in asset markets. So this white line, this chart, we will watch it over the coming months to see if we see a sharp move up in the dollar relative to the S&P, because generally speaking, as we can see from basically every one of these green boxes, it is corresponded to a decline in both gold and a decline in the S&P 500. The only exception that I was really able to find is here, where gold just ripped higher despite this DXY over SPX moving higher. So there was something idiosyncratic with gold there. But generally speaking, we have seen pullbacks in the S&P 500 and in gold when the dollar conditions get too tight, when dollars become too scarce, because that is really what we're talking about with the reverse repo. Remember, the point of it is to absorb excess dollars. So at the peak here, we had 2.5 trillion excess dollars that they didn't want in the real economy because it would cause inflation. They printed way too much money. So they ran this reverse repo all the way up to $2.5 trillion. Well, as that's being ran down, dollars are being let back into the system. The problem is that if you're trying to raise $400 billion to rebuild this Treasury General account back to kind of the range that it was in here, it can't come from the reverse repo, so it's gotta come from bank reserves. Well, both, as those $400 billion are being sucked out of the system, as those bank reserves are being drawn down, which is what we will see, that is a negative for liquidity. The amount of supply of dollars is going to be reducing. There are less and less dollars in the system. So the other thing to watch, of course, is the overnight dollar markets. We, will probably see SOFR start to have more of these little spikes where it moves sharply above the Fed funds rate, again, indicating a shortage of dollars in the system. Now, whether or not it turns into the repo rate crisis that we saw in 2019, that is a different story. For those that aren't aware, I will show here. This is the repo rate crisis, and it was actually even worse than this. The repo rate spiked by 9% in a single day. It was actually even worse intraday than this chart would suggest. This was because dollars were so scarce and the demand for them was so overpowering to the amount of actual dollars ready to be loaned that the interest rate that was being demanded for those overnight dollar loans reached atmospheric levels. And so this is what can happen during liquidity crisis or dollar liquidity shock. So we will definitely be watching the overnight dollar markets as we were looking at with this chart. That will be a good sign of stress, as will the SOFR minus the Fed funds, or the spread of SOFR over the federal funds rate that we were looking at in purple. Of course, we will also watch the yield curve and watch for any strange dynamics in the bond market, as well as, of course, whether or not we get a pop in this white line and in the dollar versus the S&P. So hopefully that was helpful. I will link a video where I go more in depth about how the price of the dollar is set, but hopefully we addressed it enough in this video, and that was at least somewhat educational. And I will catch you in the next one.